Investors turned a little cautious towards the end of the period as new coronavirus cases in a Beijing market and a German abattoir rekindled fears of a second wave. The epidemic continued to spread in the US, but China seemed to have new cases in the capital under control. China also released encouraging data for May, its second lockdown month. Industrial production rebounded by a further 4.4% year over year, a sign that it was catching up faster than consumption. Retail sales were down 2.8% year over year, but this marked an improvement on April's 7.5% decline. The big news was the Fed's decision to increase its support. The move reassured investors on the U.S. economy's capacity for resilience pending an improvement in the health crisis and the economy. Note that after the Fed's previous declarations on March 23rd and April 9th, actual bond buying had only started a few weeks and even a few months later. April 14th for commercial paper, May 12th for ETFs replicating corporate bonds, and June 16th for corporate bonds themselves. The April 9th announcement had accentuated the narrowing of investment-grade high-yield spreads. High-yield spreads then trod water between mid-April and mid-May. It would seem that announcements alone were not enough to sustain downward pressure on credit spreads, but they did help corporate debt markets return to normal. Even before the Fed had started its asset purchases, U.S. companies managed to raise $900 billion through bond issuance, most of its investment grade. Another important development that helped Wall Street and global stock markets rebound sharply was the news of a massive infrastructure stimulus plan. It will target roads, bridges, and 5G and internet infrastructure in the countryside. Market optimism was also lifted by a strong rebound in retail sales as lockdown measures were eased. The so-called control group subset of sales rose 2.1% year over year after a 7.5% drop in April. Demand was particularly strong for goods like vehicles. In contrast, there was no real improvement in industrial production. After falling 16.2% year over year in April, it declined by 15.3% in May. However, the Philly Fed reported that manufacturing in the Mid-Atlantic region increased by 27.5 in June, or 70.6 points better than May. In the political arena, Donald Trump lost support in the latest state polls on voting intentions in November's presidential and congressional elections. Joe Biden and the Democrats widened their lead, including in swing states, and look likely to win the White House and retain control of the House of Representatives. Donald Trump's management of the social crisis has also caused support among Republicans to fall to only 40%. The president is desperately searching for a new success, and China is public enemy number one. This meant him once again threatening to cut any trade links with China. Against this backdrop, markets pivoted between complacency and optimism. But the Fed's asset buying program has at least established a floor for asset prices. After the previous week's correction, we raised our overall equity ratings to neutral. And we also moved high yield and investment grade bonds to neutral weightings. Markets registered moderate gains on the back of the Fed's decision to extend its corporate bond buying program and hopes for a new $1 trillion U.S. stimulus plan focused on infrastructure investment. Even so, investors remained concerned by news that coronavirus cases had reappeared in China and risen in the U.S. At the same time, economic data remained mixed, and there was an escalation in geopolitical tensions between India and China, and also between North and South Korea. In Europe, 27 leaders tried to reach an agreement on the proposed €750 billion stimulus plan. Meanwhile, Brexit talks seem to be shifting towards a compromise. U.S. indices ended the period in positive territory, with the Dow Jones up 3.79%, the S&P 500 3.77% better, and the Nasdaq 4.74% higher. Sentiment was driven by the prospect of a $1 trillion infrastructure-heavy stimulus plan and the Fed's move to broaden its asset purchasing program to corporate bonds. Previously, it had only bought these bonds through ETFs. The decision will allow the bank to target specific sectors. Elsewhere, manufacturing in New York State only dipped by 0.2 points in June when expectations were for a severe 29.6 fall. However, surprisingly good retail sales data, up 17.7% versus expectations of 7.5%, were the real market driver. So much so that worries over coronavirus and geopolitical tensions took a back seat. The news seemed to bolster the scenario of a V-shaped recovery. Fed Chair Jerome Powell, commenting on employment and sales data to a Senate commission, said the economy had undoubtedly hit a bottom and was starting to recover from the March to April lockdown. However, he added that the pace of the recovery was still uncertain. Trade issues also weighed after the U.S. withdrew from global digital tax talks. Meanwhile, the number of COVID-19 cases and unemployed continued to rise in many U.S. states. Note that Wall Street trading volumes were thin, down more than 15% on average turnover. Japanese stocks fell sharply last Monday on fresh fears of a second COVID-19 wave, but rallied by the end of the period, leaving the Topix and Nikkei 225 0.79% and 0.22% higher. Restrictions on people's mobility and businesses were lifted further in Tokyo from June 19th. This could help the recovery accelerate, but the mood remains cautious as new infections in the capital are still running at between 10 and 50 each day. Emerging markets edged 0.8% higher last week, as at Thursday's close, with Brazil and India outperforming other regions. Chinese equity markets were also higher last week, despite new COVID-19 cases being reported in Beijing. While the number of cases is still limited, as there have only been 150 confirmed cases since June 11th, the strategic importance of Beijing as the capital city from a political perspective has forced the authorities to take control and use some of the most drastic measures for the outbreak. 500,000 individuals have been tested, with daily testing capacity rising to 100,000 people per day. Schools have also been closed and flights canceled. On the economic front, retail sales saw a sequential improvement in May, down 2.8% year over year, compared to an 8% decline in April and a 16% decline in March. Total online retail sales continued to show stellar growth in May, accelerating to the mid-teens year over year, compared to high single-digit growth in April. Premier Li Keqiang announced that financial regulators would push financial institutions to sacrifice 1.5 trillion renminbi, or $212 billion, in profits this year to support enterprises by offering lower lending rates and fees and deferring loan repayments. Well, that's all for today. Thank you for watching. Subscribe to our channel to track the market pulse and get the latest economic data. Good luck trading.